Hey everyone, Charlie here. We're running a quick survey. We want to better understand who our listeners are. Do me a huge favor and fill out that survey. It takes under a minute, and the link is in the show description. This helps us make better content for you. Thanks a ton for listening. Link in the show notes.
Today we have on Joshua Lim from FalconX, formerly at Arbelos. He recently sold his company to FalconX. One of the foremost thinkers on crypto markets. I'm saying that for you, but I don't know if you would say it yourself. But I think that you have a lot of perspective, especially from the trading side, and working as in market making and options and so on. So today we're going to pick his brain. Josh, quick intro, and then maybe if you could just tell us what you kind of do at FalconX now.
Definitely. I really appreciate you having me on here, and it's a very generous intro. I would attribute anything that looks like skill mostly to just years and years of experience in the space, and just the accrued baggage of having gone through multiple cycles. I have been in crypto for a while, since 2014. I was at Circle way back in the day, and then also started a couple of different businesses, sell-side businesses at Galaxy and Genesis, and then, like you said, most recently started my own firm called Arbelos, which was a prop trading business focused on options and derivatives. And I think I can go into kind of why I'm part of FalconX now. It's really a fortuitous thing that kind of evolved in the last year or so. But now I run markets here at this firm, and we are a prime broker that services a lot of institutions globally, hedge funds, venture firms, high net worth individuals, now corporate treasury vehicles, a lot of those. We are focused on bringing liquidity and access and really creative structuring and solutions to people who otherwise might have a little bit difficulty accessing one part of the market or another, whether it's like credit or spot trading or derivatives, or just electronic exchanges, exchange access, things like that. The company's been around since like 2017, 2018 timeframe, and it's really the whole time been more a technology company, and then more recently just as a principal trading business and financial services one-stop shop is the tagline. So I think happy to go into all the different things that are happening in the market. I think my focus historically has been a lot on options and derivatives and volatility. And more recently, because everything is now a macro correlated asset, really thinking about the impact of the administration's policies and interest rates, and also just capital flows between TradFi and crypto on all of our favorite altcoins and things like that.
Yeah. Okay, so I wanted to quickly ask you about Arbelos. I guess I mispronounced it originally, but Arbelos. So when you say that, so you're not head of markets, is this the same thing that you were doing prior? And what I'm getting at here is, at Arbelos, were you guys directional traders, market makers, all of the above? I'm kind of curious, like, were you taking, bets, or were you primarily facilitating, just like, for somebody who's not as deeply ingrained in this space? So, yeah.
Yeah, at Arbelos, we were basically trading our own capital, right? We raised a venture round, and we had that capital, and then we had lines of credits with various other firms, including the FalconX, and we used it primarily to make markets in derivatives. So it wasn't necessarily directional risk taking or anything like that, but it was a lot of market neutral strategies.
Got it. Okay. And so then, we could just jump in. Overview on the markets. We had discussed prior that you want to talk about, crypto applied volatility is like quite low right now, and sort of what to glean from that. But you want to just talk about overarching views on the market, we can dig into that.
I think more and more in the last couple of years, right? Options and nonlinear instruments in crypto have become much more prevalent, whether it's within the crypto native community using it for hedging and for yield, or kind of new market participants from the TradFi side of the world getting in, and they're already familiar with this set of tools, right? From traditional markets, from equities and FX, and they're really deploying that type of skill set into crypto. And they're doing it for various reasons, right? The most obvious reason is to get leverage, to kind of structure a specific payout that fits their view. And the view can be very tailored to, macro events, like they are positioning ahead of an ETF launch, or they believe that the Fed is going to be easing, or, very specific sort of micro catalysts. I think we see a lot of times like crypto responds very well when there are headlines in the TradFi world that macro hedge fund managers can affix to. So a good example would be in 2021, it would be things like the Coinbase listing, right? There were a lot of sort of newcomers into crypto, macro tourist type participants that came in to play that event. They're buying Bitcoin. And I guess back then a lot of it was Grayscale, right? Grayscale Trust. And then in more recent times, it would be things like, the Circle IPO, right? That was a big event, drew a lot of eyeballs into crypto, and always like around these types of events, because of the volume of interest and activity around crypto assets, and people, sort of reevaluating like the relevance of crypto to their macro portfolios. It ends up creating just a lot of capital inflows into crypto, whether it be directly into Bitcoin itself, held at a custodian, like held on chain, or via these new vehicles. And now, because there's so many new vehicles, a lot of these new corporate treasury access vehicles, the amount of capital is really getting attenuated, right? It's being distributed across so many different vehicles and formats. And now, the impact is, while the access is increasing, the impact is decreasing on a per dollar basis. So yeah, we're seeing the effects of that now playing out in the vol space.
Okay, because I think that I could sit here and pick your brain for probably hours about these treasury vehicles, and that was sort of the context of this conversation, at least from my angle. I really want to dig into this. We could start, like, let's jump in. Okay, first of all, just to like set the stage, what is FalconX's role in any capacity with these treasury vehicles? I know you guys provide liquidity, help set them up, maybe investing in them. Like, give us an overview of how you guys interact with this new phenomenon of digital asset treasuries, as they're called.
Yeah, absolutely. And this is an area that I would say most crypto firms were not deeply familiar with before, right? I think most of us grew up in the space. Maybe a lot of us did come from equities or FX or commodities, but for the most part, we spent our time in a relatively isolated world of crypto, whether it was centralized exchanges that are mostly offshore or DeFi or whatever. So there is this new world that we're all kind of like wading into. And the main way that it happens for us is we get connected to a management team, or a banker introduces us to a management team. There is a formal process that happens where there's sort of collection of interest from both crypto native and TradFi market participants. It's usually done through a banker. Some of the more prominent ones that have been involved in the space have been firms like Cantor and Cohen and BTIG. Those are kind of the more well-known names. AGP has done a few as well. These are all firms that we've worked with in the past, and they, are generally looking to collect interest across a bunch of different market participants. They're also looking to help the management teams figure out like a long-term plan for how to manage the corporate assets, the corporate treasury assets. And, there are a couple of phases, right? There's sort of the, fundraising and collection of dollars or in-kind contributions into the treasury. Then there's sort of the process of, now there's a lot of dollars that need to be deployed into the market. So what's the most efficient way to execute that? That would go through a partner that looks like us, right? We have, we onboard these corporate treasury vehicles and we provide liquidity. And that can happen in multiple formats, right? There's sort of more automated formats like APIs and UIs. There's also just chats and sort of ways that they can interact with humans directly, where we give them some idea of what's going on in the market, just market color, market dynamics. We provide them different forms of execution, whether it's like executing it on some kind of referencing some time-weighted average price, or a point-in-time trade, like a risk price on a block. And then there's generally like a financing component too, right? Not all the time will these vehicles be able to pre-fund all of their trades. So a firm like ours, we have the balance sheet to deploy into the market in anticipation of any sort of upcoming purchases. And so, we help to finance some of these things as people are collecting checks that are still on the way to them, basically, from a capital kind of call perspective. And then, finally, there's a longer term aspect of custody and staking those assets, kind of finding the utility and having a large digital treasury. Some of the teams that are focused on creating long-term value are thinking very hard, right, about sort of like on-chain native ways of generating yield and putting these assets to productive use. And that's very interesting. And it's really something that is being pioneered by these corporate vehicles rather than the ETFs and sort of all of those more passive wrappers, because there is basically like a mandate for these corporate treasury teams to optimize the use of those assets. So it's not really restricted by any prospectus or guidelines that you might be under if you are managing an ETF. That's very, very different because you're operating in a corporate treasury vehicle.
Yeah, you can go try to max out yield. Okay, we're gonna come back to a lot of this stuff, but okay, I want to start from the sort of the first thing you said. And I'm not trying to like make you go through this all chronologically because I think you gave a decent overview there, but I'm like just fascinated in like the actual intricacies of this. Okay, some investment banker has this idea. We're going to create this treasury vehicle in tandem with a management team. Okay, when you say management team, these are people outside of a current company. Is that correct? So these may be like, for example, I think today or yesterday we saw Robert Leshner buy a controlling stake in a company. Now, he hasn't, I don't think, explicitly disclosed that it's going to be a crypto treasury vehicle, but I don't know what else he's going to do with this liquor company. So, what I'm asking is, these are, when you say management team, you're talking about people who are likely already in the industry and they don't necessarily have anything to do with the business that they're intending to create a treasury vehicle into. Is that correct?
Yeah, I mean, for the most part, there's a lot of different structures for these things, but it's people that we are generally familiar with, people who have credentials and are, have some history working with digital assets. Otherwise, it would be very hard to kind of raise the capital for these types of vehicles without any sort of native expertise. I mean, obviously, some of these are companies that have existing operations and those operations are ongoing, right? So it's not as if there's like a wholesale change in management. It's more that there are people coming in with expertise in crypto.
One other side question on that. These current existing companies, do they always know that they're being taken over to become, like, is there ever any hostile takeover type stuff going on where you're just like, in essence, market buying sort of under the table, these like buying up their shares? Or is it always usually like in tandem with current, management team that actually is doing the, whatever real business they do?
I think so. This is part of the process that I'm less involved in as an investor, kind of on the crypto side of the world. But there are people who broker these deals, right? There's people who are familiar with companies like low market cap companies that are in discussions with other potential acquirers and looking for maybe a different way to take the direction of the business, right? And so like those people are open to having these discussions with, new incoming management who want to get involved and build a large corporate treasury.
Okay. And these are always existing publicly listed companies, like to the extent that there's
that's not.
No? Okay. Yeah. Explain.
Yeah. There's sort of a distinction here. Some of them are publicly traded companies that generally are low market cap companies that take on a new capital raise, and then that capital raise goes into crypto assets. There's also these things called SPACs, which special purpose acquisition corporations, I think.
Yeah.
But they're basically blank check companies that hold capital and are looking for some other acquisition target, and then at some point they merge with that acquisition target and they become an operating company. So those vehicles exist, and they've always existed for decades. And they basically, a lot of them now are getting repurposed to basically target crypto private companies that hold crypto, right? And then they do another large private raise into the sort of like merger of those two companies. And then that combined entity then can go out and also acquire even more crypto as part of, because now they've raised a bunch of cash. So that whole process takes longer. That's like a de-SPACing process that, converts a SPAC to an operating business. That could take 3 or 4 months or even more. The earlier case where you have an existing company already that does not have a bunch of cash in it and then goes and raises a private round to expand its cash holdings to go and buy crypto, that is a faster process. And the sort of, that process can happen in a matter of weeks. And this happens all the time with other companies that have nothing to do with crypto and are not doing crypto strategy. They're just raising capital in the capital markets, right? By doing a share sale. So these companies will go through that. And I think the question that you're probably asking is, how long does it take for someone in the private round, if you're investing in that, to get liquidity, right? And that window is much shorter than the kind of like the 3 to 5 months on the SPAC side. It's something like, let's call it like 45 to 60 days.
Wait, but even the 3 to 5 months on the SPAC side is not that much, right? I mean, like compared to some token unlocks, I mean, we're like going even faster in the TradFi space in terms of cliffs and whatnot than like, okay, so that's interesting. So what does the kind of structure of one of these deals look like? All right, I'm going to go back to what you said prior. You have this management team, you have these, financial engineers at one of these investment banks. They then go out to a bunch of VCs, I've heard as of late, have been getting these pitches, liquid funds, various family offices. What do those deals look like? Like, what are the terms that entice them? What is the big unlock for them? Is it quick liquidity? Is it a 20x? I mean, I've heard some pretty crazy multiples over like less than 3 month holding. But like, what are they looking at, and how does this actually work? Like, describe the structure of this.
Yeah. So there's a couple of differentiating points that people are looking for, right? Because you're right. There are tens, if not, 50 of these deals like floating around these days. And a lot of it is, so the differentiators are the quality of the asset, underlying asset, and the quality of the strategy around that asset, right? So that has to do with the credibility of the team as well, right? So the team that is well credentialed and has a lot of operating experience and is familiar with crypto as an asset class, familiar with the specific token that they're getting into, and specifically, it's like people who are generally coming from the ecosystem, right? It's like could be founders, it could be the people from the foundation. It could be folks that have run operating businesses or protocols within that, the ecosystem that has a token. And I think what we're seeing is the ones that have sort of the most credible teams are able to attract more capital because ultimately a lot of that capital is coming from ecosystem participants. It's people who are already bullish on that asset. They're either, contributing in kind, moving some of their assets into this equity vehicle, or they have cash and they're willing to deploy into that asset. The other differentiator, I would say, is sort of a capital markets strategy. So you've raised a bunch of capital, you're deploying it into your crypto asset. You're also trying to replicate the flywheel that Michael Saylor has done with strategy, right? So you're basically trying to construct a cap structure using different debt instruments, convertible bonds, preferred shares in such a way that you can raise capital optimally and then deploy that to buy more of your underlying token. And if you do that effectively, then you can obviously raise the net asset value for everyone, all of your equity holders, by arranging, basically recycling or taking that capital, buying your token at a your token is the NAV of your asset, but you're selling these assets, selling let's say these convertible bonds or this equity at a premium to that, and then you're accreting some value to your shareholders. So yeah, there's a lot of different components. I will say this, like the ones that have real ties to their own community, like the foundations and the creators of the assets themselves and the networks themselves, are able to attract, like I said, a lot more capital, a lot more attention. The ones that have well-articulated on-chain deployment strategies, whether it's just staking the asset to generate more yield, or maybe even like cultivating positions, like yield positions on chain, things like that. That has been a positive differentiator. And then the ones that have real sort of like an idea of where the fundamental drivers of the token price are, and sort of a plan around raising the capital around key events, like basically timing, your capital raises such that you can take that capital and deploy it into your underlying asset optimally. Those are the teams that have really outperformed in terms of capital raising this cycle.
The Gwart Show is sponsored by Ellipsis Labs, who I've been following for 3 years now. They're one of the strongest teams I know in crypto. Ellipsis Labs is a small engineering team with a flat structure. They build complex systems, primarily in Rust. For engineers who like challenges, here's the kind of problem they solve. A layer 2 blockchain needs to maintain 100 million accounts and generate a state root after each transaction batch. The root must be built within 50 milliseconds. How would you design the system to ensure the root construction is fast enough? High-performance challenges are core to Ellipsis Labs' mission as they build modern crypto finance. They believe finance needs more than an upgrade. It needs a complete rewrite. The success of their first product, Phoenix V1, speaks for itself, doing over $70 billion in organic trading volume. Now, Ellipsis Labs is building Atlas, the blockchain purpose-built for verifiable finance. I know this team personally, and I like them because they're unique in the crypto space. They have a long-term focus, they work in person from their New York City headquarters, and they're here to build products that fundamentally change the world of finance. If you want to learn more about their open roles, go to ellipsislabs.xyz/careers.
It sounds to me, right? You can refute this or you can say no comment, but it sounds to me like when you say quality management teams, like they're not managing like factories or people building iPhones. It sounds more like they're quality bull posters. Or the second thing is, do they have access to global capital markets where they can sort of keep running the flywheel? I mean, that would be what I take away from like management team specifically, like Tom Lee, right? Is his name Tom Lee, right? Like he's got sort of a background in going on CNBC and bull posting. Like that strikes me as what I think of now when you say like quality management team. I'm like, oh, the guy who can relentlessly shill, right? But then there's like this positive, like reinforcing cycle where if you are quality at shilling, well, then you can continuously raise more. Is this like directionally correct?
That's directionally correct. And we can't really comment on like any specific vehicle or team.
That's fine.
But yeah, I mean, to your point, right? A lot of the value creation is actually coming from being able to raise capital at favorable terms and then redeploying it into the token, right? Yeah. So there is a virtuous cycle of just being the best person at that, being the best spokesperson for your asset, just having the most visibility. And I mean, that accrues value to shareholders long term. I mean, that's true even if you're not in a treasury asset vehicle, right? Like, like any
Elon.
Crypto company, like Elon, or like any crypto company, if you've got like a good figurehead, they're pounding the table for you, and then you're going to win, right?
Okay, I want to go back to one other thing, and then we'll move on to more things about treasury companies. But I want to go back to one other thing. Prior to these things, like you said, they may some of these deals may see 45 to 60 days before liquidity. Some may, like the SPACified versions, may be closer to 3 to 5 months or something. What are the multiples that these people who are in on the ground floor getting? I mean, I have to name specifics, but like what would be really positive outcome for, like I was saying, family office, VC, liquid fund? What are they looking for in that time period, or what have you observed thus far, maybe?
Right. So there's two components when you think about the price of one of these investments, the common stock, right? The base thing is the NAV, the actual sort of like fundamental value per share of the assets that the vehicle is holding. And the ideal situation is that the NAV of your treasury just constantly goes up, right? That can happen in two ways as well, right? So just to break the NAV piece up, there's the accretion of number of units per share, and that comes from this idea of like being able to raise capital at a favorable rate and then redeploying it such that the number of units of Bitcoin, let's say you own per share of strategy, increases over time. And then there's the second component, which is the price of the underlying token itself goes up in value, right? So, and there's a timing component of that too, right? You want to deploy more capital when the price of your token is lower, and then you reap the benefits as it appreciates. So, the NAV in dollar terms basically is a function of those two things. There's a third piece, which is the multiple to NAV, right? So this is like the premium that the market rewards you and your share price because they believe in you as an operator, right? As a management team, that you can continue this strategy of increasing the NAV per share. And you can continue to raise capital favorably and deploy it at favorable times, all that good stuff. So there's, people call it, that's the MNAV basically is the shorthand. And that number has ranged quite dramatically, right, for a lot of these assets over time. And it's very cyclical, right? If you look at last cycle, there were even moments in time where the strategy MNAV traded below parity. And now, a lot of these things, even like the very mature ones, even the ones that, when I say mature, I mean like all the shares have become, fully vested and tradable, unlocked effectively, and have existed for a couple of months, and the market has had time to reprice the assets. I mean, they're still trading in, let's say, like a 2 to 4 to 6x of NAV, right? So in some cases, it's and we've also seen, right, in some cases, before the shares become effective, meaning like they're free to be sold into the market from the private sale, these things can trade up to 20x or 30x of the NAV. So it doesn't necessarily mean like those profits are, you can't lock them in because, the shares are not liquid for the people who got in at whatever 1 times NAV, right? Those shares are still not tradable. And oftentimes, because these are very small companies to begin with, there's no borrow on the shares. So it's not as though you can like hedge the position. And that's why I think people like you maybe are looking at these things like, people are just printing money on these things, but not necessarily. Like you got to wait until the moment where the shares become freely tradable and then measure the uplift in MNAV from there, basically.
Okay, but all right, I want you to give me like a specific, just if you like, I'll put you on the other side. Say you are a family office, you invest in one of these strategies, you're fully liquid after 6 months. What multiple do you want? Like, I'm reluctant to even ascribe any type of anything. You could call this cost of capital. I'm not even looking at like it's just the game, right? And what would you want after 6 months? Like what multiple, having taken on that, what you were saying, not liquid, not marginable. What are you looking for on the other side of this?
Right. So I would kind of flip it the other way, right? It's like, why would you invest in the strategy in the first place? I think the reason you would want to do this is you would want a more liquid way that has maybe potentially more upside of holding some token that you would otherwise hold directly on chain, right? So it's like, okay, I was going to buy Bitcoin anyway, but I can subscribe into this vehicle at 1 times NAV, and potentially, like maybe when I'm sort of done with my thesis in 3 to 6 months, this thing is tradable at 1.5 to 2x NAV, as MicroStrategy or strategy has been in the last couple of months. That's a great trade for me because I'm getting a 50% pickup on something I would have wanted to hold anyway in that time frame.
Yeah, that's fair. We're playing this out with all these different tokens now, and it seems like we're going to go down the list of the whole CoinGecko, right? And what is the advantage now? I mean, is it unrealistic to try to do this with Bitcoin now and instead, go after a smaller asset, or is it something where you can position yourself uniquely and still go after Bitcoin for some reason?
Yeah, I mean, I think even to this day, we're seeing fresh Bitcoin vehicles, right? I mean, just the other day, there's an announcement of a new $4 billion vehicle. So, and these new vehicles have differentiating points to them. There's real reasons why they should exist, and very credible teams with differentiated strategies. So, I do think that there is a bit of with diligence, and you can make decisions around asset selection and things like that provide some edge, to what you're doing as an investor. It's not all just, hey, this is another one, let's just do it and just throw money at it. It is like a considered process, I would say.
That makes sense. Okay. When you were talking about maybe being able to generate yield strategies for some of these tokens that, either are more integrated within like DeFi, for example, what is the risk profile that some of these guys are taking on? Like, is it pure play staking, running their own validators? Maybe that's on the safer side of the spectrum, or are they straight up degenning on, 10,000% APY, LP pools or whatever? Like, what does that look like, at least for the time being?
Yeah, I mean, I think at a very basic level, it's just staking into the network, and it's just staking yield. I think some people are taking a more hands-on approach, running their own kind of validators and software and things like that, and trying to optimize. So that's pretty positive, I would say, just for the network itself. Like, you have people who are trying to actually build and innovate there. And then there are some folks that are even considering like more proactive things that are involved, taking advantage of the underlying like volatility of the asset itself, and kind of trading around the price of the asset so that you extract even more yield, right? That you can do if you're holding a large amount of your underlying token. That can happen both on-chain and off-chain, right? I think people have different mandates, like what they can and can't do. I don't think anyone's doing anything extreme because in the worst case, right, like a badly managed treasury, if there's some sort of capital loss, I mean, that can really snowball into a very bad situation. Like you could result in a permanent discount to NAV situation, right, for that asset, and you wouldn't be able to necessarily close the gap, because if those assets are permanently impaired in some way, then you couldn't do like a buyback. That's really like the safety valve for a lot of these things. Like, people are talking about, well, can these things trade at a permanent discount to NAV? There's always the element of you take your assets, if they're liquid in your treasury, you dispose of those assets for cash, and then you do a share buyback to bring the NAV back to one, basically, or the multiple to NAV. So that's like always the escape valve that you have to be careful to preserve that optionality for yourself by deploying only into liquid strategies that have minimal possibility of downside. Yeah.
Let's talk about some of the criticisms or concerns, and I have a bunch of different questions. We're going to put aside the kind of ideological, this isn't crypto, this isn't the, like, let's just put that aside for a second. It's that I don't care so much about that. A lot of times when I hear people say like, this is going to blow up for this or XYZ reasons, I look at this and I'm like, I don't think so, but also I can't tell you why that's wrong. So it's one of these things where there's a lot of people that are convinced, right, that these are just doomed and that this is like going to go terribly, terribly awry. From just an overarching view, where does something like this go wrong? And I don't know, like, it's easy to say, well, if MicroStrategy for some reason blew up, that would be horrible, but that would be horrible for all of crypto and all of markets. So, I mean, where do you see like the biggest risks in doing these things? Then I'll price some more because I have some more questions.
Yeah. So, like I said, right, there's always the possibility of sort of downsizing these vehicles over time if there's a situation where nobody wants equity access to, let's say, Bitcoin anymore, right? Like, nobody wants to hold Bitcoin via a corporate treasury. Then the corporate treasury should just start to sell its asset and buy back its shares until there's no more shares outstanding, right? And in that way, this is sort of self-regulating. Now, I think people are asking, what are worst case outcomes? I mean, the worst case outcomes are these things are not managed correctly, and there's NAV like real losses that accrue to shareholders because of this mismanagement. There could be situations like a hack or something like that could happen. I mean, these are things that also exist. There are dangers that exist for things like ETFs as well, right? Now, the other situation that I guess people are like, well, how do these things permanently trade at a discount? We've already gone through the fact that you can do a share buyback and try to bring these things back to NAV if there is a permanent discount. But there could be just a market-wide situation and this existed like last cycle in the bear market, where just crypto in general is out of favor. And if crypto in general is out of favor and nobody wants to hold any asset, even if it's trading at a massive discount to its fair value, then these things could just persistently trade at a discount, even if, and I guess the case of the management teams trying to like close the gap between the NAV and the underlying asset, they could do that, and they could be maybe even like forced to do that by their shareholders. But there wouldn't necessarily be any impetus for them to do that in a bear market, right? Because a lot of these management teams probably have an incentive where they get paid based on the size of the treasury that they're managing, or sort of in dollar terms, right? Like it's better for them when everything is up and they hold more assets. So yeah, that's good. There's going to be an alignment problem, right, at some point between like management and shareholders. There's going to be just all kinds of the normal things that exist in corporations and governance issues around that. But yeah, it's one of these things where it's like there's no uniquely crypto problem or solution here. These are all just problems and solutions that all corporations have, and the same sort of governance solutions around that will also apply to these corporate access vehicles.
So how long do you think that these things just trade at a premium? I mean, I guess with strategy, the positive outcome is that it's permanent, but how long does something like this persist? I mean, how long can you tap into all of these different market dislocations that a lot of us think, okay, well, this is like the fiat Ponzi, right? Like this is one of the end states of the fiat Ponzi, but in the reality, like, okay, eventually if markets are efficient, these converge, but like, who's to say when? What is your like rationale or long-term thinking on this?
Yeah, I think what we're looking for is one, the underlying asset, right? Is there enough enthusiasm for crypto generally that there's going to be investor demand to get more exposure to it? And I think that's a good indicator, right? Like when the market starts to turn in crypto, and we all know that we're in a very cyclical market, and that will happen. Hopefully not anytime soon, but when it does happen, then all of these things trade at a higher beta to its underlying asset because of the same, because of the reason that we like them now, because they have a positive greater than 1 MNAV, right? So we all know that. Now, the other question is like, okay, so the MNAVs themselves are greater than 1. What if the MNAVs just converge back to 1, right? Yeah. So that can happen. And like that did happen, for instance, for Grayscale, and it happened for Strategy. I think that will happen when there is that just a lot less enthusiasm. And I would say even look at things like retail favorite kind of meme stocks, right? That's probably your best indicator of just market appetite for risk in this environment. And if you look at those, and those are still outperforming, and you still have a lot of hot money kind of rotating between all of these topical meme stocks, right? Whether things like Tesla and Palantir and things like that, right? Then there will be appetite for these types of corporate treasury vehicles, because it's the same idea. It's like people are trading sort of market sentiment and market psychology and reflexivity. And when that starts to turn, then you'll get the MNAVs compressing back to 1. So there's a lot of things you can observe just outside of these vehicles themselves, just to get a gauge of where the market's price these things.
Yeah. The other thing too is Saylor has been able, I mean, everyone knows this, but Saylor's been able to do a lot of different types of sort of financial engineering, and he's been able to do it at size, right? And that makes a huge difference when we're talking about strategy and how they play this out. Do you have confidence that, the next 2 through 1,000 of these companies, like we were talking about this a little bit prior, like access to capital markets, right? This is like the fundamental unlock, right? With these management teams, like, can they do that?
Right.
But do you have confidence that these companies are going to, observe strategy and say, oh yes, like I could pull these same kind of, very intricate financial engineering to just continuously apply, share, like you just push shares out there indefinitely. Like it doesn't seem that the 1,000th will obviously have the same ability or terms to do that as Saylor. So what is your kind of like, is that where we may see a slowing down of this, is when these guys can't do the same level of, financial engineering?
Yeah, I mean, look, these things take a village to get off the ground, right? It's there's a lot of steps and filters along the way, right? There's like lawyers and there's bankers, and then there's investors that have to, invest, will be willing to commit capital into it. And especially the ones that you're talking about that have more complicated capital structures that involve debt and preferreds, and just different types of instruments. The buyers of those instruments are sophisticated investors. They're convertible bond funds. They're macro firms. They're distressed debt shops. Just firms that credit shops, like firms that have just a great many experts in that particular type of instrument. And so that's actually where the edge comes from when it comes to these management teams. It's like, if these are really professional investors, they're looking for credible management teams that they can trust with hundreds of millions of dollars. And they know that these management teams will do right by their investors, both debt and equity. And yeah, I mean, only I think the best teams can resort to these other parts that are just not outside of just purely common stock, right? Things that require a little bit of nuance, and have a lot of, like, let's say, covenants or other things around them that need to be enforced.
Hey, Will here with Blockspace Media. Did you know that we have individual feeds for all our shows? If you're watching the Mining Pod, Bitcoin Season 2, or the Gwart Show, be sure to check out the individual feeds. You can find them on your podcast player of choice, whether that be Spotify, Apple, YouTube, etc. Just type in Blockspace Media and you'll find all our shows pop up, or just type in the individual show name like the Mining Pod or Bitcoin Season 2. Be sure to hit that subscribe and give us a 5-star rating so we can continue to bring you the best content in Bitcoin.
Sure.
Okay, let's shift to just equity, the equitization of crypto in general. It's not the correct terminology, but like, for example, do we have an alt season now that everybody wants to gamble on real equities now? Like, what are you seeing? What is your, maybe, like, having been in crypto for quite a while now, we're all talking about this tectonic shift toward TradFi. What do you see with, like, all of these new equities coming on chain? Or all of these new equities being traded?
Yeah. Well, I actually think what's happening is a lot of the speculative capital that used to go into altcoins looking for 10Xs are now just hunting in small cap equities, right? Or sort of like looking for the next meme stock that catches the retail attention, right? And I think, that is unfortunate in many ways because, we thrive in an industry that has that sort of optimism and speculative impulse and sort of like uncapped upside. That's why a lot of people trade crypto, and the fact that that's sort of migrating into another type of risk asset is not great for us. But on the flip side, right? Like, there are ways that we as an industry can really nurture that sort of speculative spirit, which has always driven crypto, right? And the best and primary use case for crypto has always been speculation, right? We all know that. Like, the products that are most successful have been things like Hyperliquid and Pump, and anything that sort of brings out that animal spirit. And I think that's probably going to be a big part of the next cycle, which is just if there are interesting ways to get upside in other asset classes, all of those things are going to be turned into RWAs and tokenized on chain, or they're going to be, perp dexes launched on those assets quickly. And I think a lot of this is just because there's maybe more engagement from regulators and there's more of a clear framework on how to launch some of these products and venues, and in some cases, launch it for this particular class of customer offshore because you can't touch this other set of customers. And as long as people kind of follow the rules around that, then a lot of the innovation can happen on chain. So, I guess your question is just more around the equitization of crypto and what does that mean for crypto long term. I mean, I actually think that it's going to flip the other way. I think there's going to be a tokenization of equities, really. And maybe both of them coexist in the long run, but it's more likely to me that more and more financial activity just migrates on. We were already kind of seeing this with every bank in the world announcing a stablecoin project now. And I think post some of the bills that are going around the House and the Senate, I think that only continues, not just with like, T-bills, but then you're talking about private, credit and private credit, and then it'll be equities and commodities and FX. Now, the other side of the equation, I think, is just altcoins generally, like what happens, and kind of already got a taste of it, right? Which is basically the things that are don't have real fundamental drivers of value and value accrual will just decay over time. And it's no longer sufficient, right, for a governance token to be associated with a well-known protocol brand and a set of VCs behind it. Like, it needs to actually have a way to generate revenue and cash flows and have a fee switch that can be flipped on, even if it's not flipped on now, to bring that value back to the holders of the token. And the most successful case of this is obviously hype in this environment. So we are starting to see that very sort of like bifurcated market where some tokens really outperform, and it's outperforming because the crypto people are themselves long-term believers in it. But then all TradFi people, when they come in and they want to start picking tokens in crypto to allocate into, they're really gravitating towards those tokens because they understand it. They can measure it with the same types of, price to equity, sort of, EV to EBITDA type like metrics that they apply to stocks. They can apply it to these governance tokens that have buybacks or other sort of things going around them. So I do think, and then the long tail of things that are unable to get sufficient user traction or really don't even have, like, let's say, a revenue model, those will just decay over time. And yeah.
Okay, you were a professional trader. I talked to a lot of mechanism designers, and now I'm talking to somebody who was very much a professional trader and understands how markets work efficiently. When you say that we're going to bring equities, commodities, FX on chain, do you think we're trading equities on Solana in 10 years? You know latency, you understand, execution, you understand being able to move liquidity and size and not get front run. When people say on chain, a lot of times I say, what do you mean by on chain, right? Because right. I'm skeptical of that. Now, Robinhood's L2 with a single sequencer that acts functionally the exact same way that their front-end app works, that matches orders with Citadel, and they have to provide, in BBO or whatever. Okay, that's different. But when we're talking about on-chain, I don't know. I mean, and so I'm asking a trader now, like, you think we're trading equities on Solana?
Great question. I think that's the wrong way to frame it, because there are multiple types of traders that use these products, right? If you ask someone who uses Robinhood, right, to trade stocks, they are not thinking about the latency of their trades execution, right? They're not thinking about the quality of the execution and how much spread they're paying. And the reason we know that is because Citadel is making a ton of money on that flow, right? No one's really asking that question. And same thing, like the early days of crypto, when people were buying Bitcoin and ETH through a Coinbase wallet and paying whatever 1%, 2%, 5% spreads. I'm not sure if it was ever that wide, but a lot, basically, right? Like, why did they not care? It's because those assets were, basically had a lot of upside. They had a lot of convexity, and they're willing to pay the spreads to justify getting a position. And it frankly was the lowest friction way to get access to the asset class or that particular asset. And so I think people pay for convenience, and I think people pay for, a good user experience. And I think that's what you get it doesn't necessarily have to be the most efficient execution or the best price or, the fastest sort of chain experience to get into Apple stock or something like that, right? It just has to be easy and good enough. And so I think if those are sort of like your benchmarks, then what does that mean, right? That means like people will, there will be a class of market makers and liquidity providers that translate liquidity on-chain to off-chain sources. And just like the way we have, solvers and searchers that sort of optimize the way people interact in DeFi pools and make sure those prices stay in line with CeFi, sexes and like Binance, et cetera, and making sure the arbs are not too wide. I mean, the arbs are still there, obviously, but like because there's enough people competing over that flow, the amount of extraction becomes more compressed over time. Right. And that's why you have people complaining like, oh, there's not as much MEV on chain anymore. And that's a good thing for most users. Right. And I think that same thing will happen with stocks.
Okay. Okay. What do you think of 24/7 markets or 24/5 markets? Like, is this a big unlock?
Look, I mean, there's a reason why Bitcoin is a powerful asset on weekends as a risk indicator, right? Because people are actually, it's the only market that's open. And at this point, it's like the only market that's open in real size. Like you can actually move some size over weekends versus other things in the market. So, and there's enough like crypto, I guess, degens like us that are still providing liquidity on the weekends to institutional investors. They'll give us a call and say, I want to buy $100 million of something or sell it. And that has real value. And, that's a unique property of crypto now, but I imagine it won't be in the future. I imagine everything will be tradable in one form or another on chain. And so it might be wider, right? Like everything is wider on weekends or overnight where there's fewer eyeballs on it and fewer balance sheets that are able to take risk. But I think that it's generally a good thing because people are always trying to price where risk is. Like this was very, very prevalent and it's kind of important during the whole Iran situation around the Strait of Hormuz. Like a lot of people were actually just trading Bitcoin on every news update coming out of that region. So yeah, I think it's a good thing.
Yeah. Do you follow any do you follow Polymarket stuff at all and who's trading on there?
Yeah. I mean, I follow it in the sense that like people will always throw a market into some trading chat when there's an event coming up. Yeah.
What do you think of what do you think of prediction markets as sort of
generally?
Well, it may perhaps also just an extension of what you were saying prior, right? Like, being able to price risk and utilizing that maybe in financial markets. I mean, this is like a massive obsession right now. Obviously, prediction markets are quite the rage. So I'm just curious from a trader's perspective.
Right. Well, yeah. I mean, there's obviously the when you think about the change in price of an asset due to some event, it's obviously two things, right? It's like what is the event going to happen? Yes or no, the probability of it. And then the second thing is if it happens, what is the impact to the revenue of this stock or the what is the impact to market sentiment and the desire to hold like non-dollar assets or something like that, right? So there's like a reaction function to the event. And like if you are a portfolio manager and you're holding a bunch of financial assets and you're holding something like Bitcoin on your balance sheet, then you actually want to trade the underlying asset because it captures both types of things, both elements. It captures the probability of something happening as well as like the expected reaction function if it does happen. Whereas if you're only trading the Polymarket side, you're only trading like the actual probability of something happening. It's almost like, to me, it's kind of like Bitcoin, like hash rate markets, like when back in the day, right? People would trade these things, and it's like, okay, well, you could trade the amount of Bitcoin you're going to produce in a certain amount of time, or you could also trade like the difficulty. But the difficulty is just like one input to how much you get out of it, how much Bitcoin you get. So, like the price of Bitcoin also matters, right? Like for instance, so that's it's like that. That's kind of probably the best analog. Yeah.
Yeah. All right. Fantastic. I think we covered pretty much everything. Do you think so? Did we miss anything?
Well, we didn't talk about options much, so that's okay.
Well, okay. So yeah, the thing is I had Wilson.
Oh yeah, that's right. That's right. Yeah.
So I was like, I just had to probe a ton about treasury companies. I feel like we got a good rundown of that.
Are you generally skeptical of them, or what's your view on the whole
on treasury companies?
Yeah.
I don't know. I mean, it seems it's like a Ponzi, but it also, I'm not petrified of the risk. Like I think you state it much more eloquently and concisely than I do, which is that there's X amount of crypto assets backing these. And in theory, right, assuming you don't have some
Yeah.
like degenerate or fraudulent management team, they should trade roughly at worst case scenario, roughly the price of the asset. So I don't know. I can see why people find this to be a massive Ponzi, but I also kind of understand why it works. What I am skeptical of is the, 1,000th person doing this, like who has probably very little acumen in navigating traditional financial markets to raise capital, and thinks that because of their name, that they're going to be able to run one of these things up. And that's where I'm like, okay, I don't know about all that. But also I don't know about these kind of really random. I mean, what are the most random assets you've seen come along? I mean, there was like there's been some bottom tier shitters that have come along as these, right? Like, how do you view this? Like, or do you guys not engage with that so much?
No, I mean, I think the ones that are the most successful, if it's out of the majors, is basically some asset that you can tie to like a real narrative, like a narrative that people want exposure to, but there's not enough exposure vehicles to. So I guess one that is pretty obvious is Circle, right? Like Circle is trading at $230 a share. And it's because people really believe in the stablecoin narrative. We just had a bill that's going through Congress, and it looks pretty positive for stablecoin issuers, and that happening more and more in the US. And then we also have, just generally a lot of banks and things like that announcing projects around this. So I do feel like if there's tokens out there that are like affiliated with stablecoins and want to brand themselves as, this is a way for the public market to get exposure to this narrative. Yeah. That's it. That's easy, right? It's an easy sell. Yeah. And it fills a niche. So there's probably more things like that, right? So there's like AI, for instance, right? There's an appetite for AI exposure, and the thesis is, crypto enables AI networks to work better because of the sort of like payments happening between agents and things like that on chain, or coordination between agents happening on chain. And so there could be another one that's like a pretty strong narrative there, and create a vehicle around that.
What are your takeaways from the Circle IPO? Also, side note, it's come back down a little bit, right? So clearly there was some extreme volatility.
Yeah. Well, the way I would think about it is there's just a very big gulf. And I think everyone was a little bit caught off guard between just the retail market appetite for risk and speculation, and what bankers and, sort of like staid financial professionals were pricing these things at, right? And if it's pretty obvious in like the secondary markets too, even for some companies that are trying to get to public markets, this year or next year. If you look at where the shares are trading in the second, they're starting to creep off, right? But the secondary markets, the private markets, they're very conservative levels relative to where some of these public companies are trading at on multiples. So it's clear that there's just like this gulf between where people think real, like the sort of fair fundamental value for some of these things are, maybe looking at comps in publicly traded fintech companies, and where crypto people, when they take their money out of crypto and they go pour it into stocks, the way they trade crypto and alts is now how they are trading stocks. Right. Like,
right, exactly.
That's just how it is. Yeah.
Yeah. And that's why when people are saying like, oh, it's like they grossly mispriced this, I was like, no, they were doing some type of, DCF or something. They were looking at the financials and saying like, this is roughly what this should be trading at. Right. So it's like kind of the inverse. Right. And it does maybe somewhat call it a question. I mean, you were talking about how, tokens now, I think this is a very legitimate point. Like Hype, for example, people can understand the revenue model. People can understand like currently they're doing buybacks, like just generates real fees and stuff. But then we Circle onto the publicly listed world's biggest stock exchange, and people run it up. And so it's like you're exactly right. I mean, we're trading it exactly as we would trade some pump.fun 3-hour-old coin, right? It's like the exact same principle. So it is kind of bizarre. But it does seem like this is, I don't know how long this persists, but it seems like there's like some generational opportunity right now. If you can figure out some catchphrase to bring into public markets. And like, that's why you were I feel like you were semi advertising. Like, if anybody's got some AI crypto agentic ideas there, hit me up.
Yeah, exactly. I mean, everything's just about narrative these days. And that's something we all invented in crypto, right? That's one thing that we brought back to TradFi. So yeah.
Yeah. All right. Well, I feel like we've definitely hit on everything. I guess we didn't talk about options that much, but like I said,
that's okay.
I had to get a full overview of the DATs, as you call them. Yeah.
Love it. Yeah.
And you obviously, like, you should come back on sometime. I know you're kind of hard to pin down, but this has been like 3-6 months in the works, this podcast, but finally got you on. So.
Hey everyone, Charlie here. We're running a quick survey. We want to better understand who our listeners are. Do me a huge favor and fill out that survey. It takes under a minute, and the link is in the show description. This helps us make better content for you. Thanks a ton for listening. Link in the show notes.